All right, everyone, 2022 is here. Was 2021 what you expected? Did it go by really fast? Did you outperform? Did it punch you in the face multiple times? Either way, we're starting over this year. We're going to tackle this year. We're going to tackle it aggressively. We're going to build a financial independence foundation for ourselves and for our legacy that will last generations. And we're going to talk about the strategy for that today on the Ultimate Crowdsourced Personal Finance Show. This is Choose FI.
You're listening to Choose FI Radio. The blueprint for financial independence lives here. If you're looking to unlock the secrets to financial independence and early retirement, you're in the right place. Stay tuned and join a community of like-minded people who are getting off the hamster wheel and taking control of their lives in the pursuit of financial independence. Choose FI, your home for financial independence online.
All right, guys, very excited to dive into this week's episode. And, we always try to thematically figure out what we're going to do. And it always feels appropriate when you're starting a new year to talk about getting started. So to help me with this, I have my co-host Brad here with me today. How you doing, buddy?
Hey, Jonathan, I am doing quite well. Yeah, it's hard to believe. New year, right? It's funny. Like a lot of these things, I feel like, New Year's resolutions and these arbitrary, the month changed, so let's celebrate, yada, yada, yada. But it does feel like that hope, right? Like you said, was 2021 exactly what you hoped for? Probably not for most of us. I think it's fair to say. But there's always hope, right? And that's actually one of the kind of cool, I know you're laughing uncontrollably now, but I think that's one of the cool parts about FI is it enables us to really think in a different way than a lot of people do. And I don't mean to make that sound like grandiose, like we're some special beings or anything like that, but we're able to kind of take a step back, survey the field, understand the rules of the financial game of life. We have a different perspective. And I think for me, at least, that gives me a little more solace when it comes to, all right, sometimes life punches you in the face. Right? That might be on a micro level, or it might be like we've experienced the last couple of years on a very macro level. But what do? Do you sit there and cry about it? Or do you realize, all right, the world is what it is. The best that I can do is look forward, and I can make changes that work for myself, my life, my family, my community, all of these things. So I choose to look at it as hopeful, as opposed to, again, the last couple of years, they haven't been what I hoped for, right? Mm-hmm. But that doesn't mean they were bad for me personally. I mean, obviously there've been bad aspects, but I think it's all about a perspective. So that's a very long-winded way of saying Happy New Year, buddy.
Happy New Year. There's a solid chance that 2022 looks exactly like 2021. I mean, let's just be realistic. Yeah. And what's kind of interesting about that is that, just as we highlighted in the episode just this past week and the week before, there are so many people that, in spite of everything that life has thrown at us, could identify significant tangible wins. They could look at the glass and they could say the glass is half full, while many of us are looking at the few drops left in the glass and saying, I'm bleeding out on the floor. There were many individuals that could identify significant wins. And when you looked at the theme, and obviously we're a financial show, but when you looked at the theme, I think one of the things that allowed people to be very happy about, where they were, both in a financial place, but also around the lifestyle design stuff, was a common foundation that they had. Effectively, they were able to make advanced financial moves because they had the basics in place. That's kind of where I'm going with that, right? You can get to the 201, the 301 stuff. And then I think we even mentioned there is some aspect of moving past the basics of finance and starting to think more about the lifestyle design, really looking at that as a privilege, but it's afforded to you because the foundations are in place. And so I thought what we could do today is do a getting started audit. And I know for some of you that maybe identify with being significantly farther down the path, I think it's still going to be valuable for you, because although it's being framed maybe in this moment as a getting started audit, I think it's probably even better framed as an annual audit, an annual review, taking a look at our check. Yeah, it's a checkup. It's a balance sheet. it's a year in review. Where are we, which is useful for you, whether you're starting out or you're really well in the path. But there's also, where were we and how do we compare? Where are we on our path to financial independence now? So Brad, comments on that, because I know this is something you have been practicing for many years.
Yeah. Well, first I wanted to touch on, like you said, the 201 and 301, and in relation to the foundation, right? I think one of the cool things about personal finance to a large degree is once you have the foundation right, once you've really focused on setting things up on autopilot and really finding the simplicity in your finances, most of it does kind of run on that autopilot. And, you see so many of these people online trying to sell like the insider's secrets and, pay me $14.99 and I'll give you the secrets of investing, right? Like there are just so few of these secrets that I've ever seen it in my experience, at least. There's just nothing there. There's no there, ultimately. A lot of finance is doing the work, right? It's getting that foundation. It's laying the ground game. It's increasing your income. It's cutting your expenses. It's figuring out, how am I going to save and where am I going to direct that money? How am I going to take my brain out of this? Because what really screws up our long-term investing the most is our own silly little human brains who think we can outperform. We're going to sell at the right time, buy at the right time. Like it doesn't work that way.
Every time I try, I'm impressed by how badly I fail. I'm like, this is like, you're like, oh, yeah, I've got all this figured out. I'm so advanced. Like I see the trends. It's one of those things where like everybody called the 2008 financial crisis with the benefit of hindsight. Everybody looks back and said, I knew it was coming. But also look at the people that like were suggesting financial moves that 12 years later have like woefully underperformed the market in every single way. And the few times that I feel like I'm tempted to grab that prognostication mantle and lay down based on all of my insight and all of my logic, here's exactly what's going to happen over the next 4 months, I get punched in the face and put back in my place. Like, all right, I don't know. Yeah, I don't know. It's just, you can't outguess things. And so how do we not get left behind?
Yeah. I mean, we do the foundational aspects. And like you said, a lot of that comes back to, all right, you set the path, but you need to have this checkup every year. And I think the very first thing we tell people when they're finding the FI community. So like you said, all right, if you're starting on day one, the same advice would be what we're going to give people who have been on the path to FI for 5 or 10 years, which again, it's that checkup. But that advice is you need to, if you're getting started, probably for the first time in your life, put down on paper or on Excel or on Google Docs or whatever it is, what is your financial position right now? And I know, Jonathan, you're going to go through this in depth, but in essence, you need to figure out, hey, what am I bringing in? What's my income? What are my expenses? And then on the balance sheet side, that's, fancy accountant speak for just basically, what do I own? What are my assets? And what do I owe? What are my liabilities? And then you figure out, hey, what am I actually worth, right? You take what you own, you subtract out what you owe, and hopefully, ideal world, you come out with a positive number. That means you have some assets. If not, you come out with a negative number. Jonathan, that's where you were not all that long ago, right? That's where many members of our community are. It's not hopeless. It's not even a negative, right? It is what it is. That's the important. There's no beating yourself up for the past. It's just, where am I today, right? And you need to be honest with yourself. And again, for people who have been on the path to FI, you might put your expenses in front of you and not realize that, hey, there's been some lifestyle creep. And that lifestyle creep is fine if it's intentional and it's done based on value. But if it's, hey, I forgot to cancel whatever, Apple TV because I like Ted Lasso, but I've been paying for it for a year, right? Like, okay, that's kind of a problem.
That season was over months ago. They haven't produced anything new for any other show. Like, are you still getting your value? You know what you have, Brad, when you have Hulu, Netflix, Amazon Prime, and Apple TV all combined? You have a cable bill. They're not really beating the system anymore.
We are not gaming the system at all. It's so funny. Like between what you pay your cable company just for internet, right? And all of those. I'm now getting Paramount Plus, Jonathan.
Somebody had a plan.
Survivor.
Paramount Plus.
Yeah.
Oh, they have Survivor. Oh, I heard that. And
they have Australian Survivor, which is actually fantastic. So
I remember that 5 minutes where you were thinking about applying for Survivor, and then your wife heard the episode and just laughed just hysterically at the thought. And you were like, oh, wow. That was like a reality check, wasn't it?
Yeah, that was hilarious. I think I would do well gameplay wise, but yeah, I wouldn't last 2 nights of 3 hours of sleep.
we've covered this before, but yeah, you're right. Gameplay wise, mental aptitude, like you see the edges, you see the angles, but then you don't get sleep and you don't get the exact food. And then suddenly you're like a hermit crawled up in the corner. Like, what's that one in Frodo and the Hobbit? And it's like,
my precious. Yeah, I'm a shell of a human being. That's for sure.
Okay. All right. Back to the show. Getting started on it. So yes, you kind of spoiled it a little bit, but yeah, obviously what you make minus what you spend is equal to this difference, this gap. What have you done with it? What is your actual net worth? What we're not going to do almost by design is talk about a budget. I really think people are listening to this thinking, oh, they're going to get me on a budget. Not the point of this. Not the point at all. This is an audit. A budget is constraints. It's putting rules on how much you're going to spend in different categories, which I'm not saying that I'm against that right now. You could make cases for that or against it, but that's not what we're suggesting today. We just want an accurate picture of what your life actually costs and how much margin you have, right? Like if your expenses exceed your income, it's going to lead to a bad place over even a relatively short period of time, right? That's kind of obvious. So we need to start really, even though we're going to talk about expenses here in a second, we need to start with income. And the reason we want to start with that is there's a lot of us that probably, let's say we have a, $80,000 a year income, a great income, $100,000 a year, whatever it is. You have this, you think about this as being your income. And I think the failure there is to not recognize that your largest expense by likely miles for most of us, we can make the case either way, I guess, but I think it's important for this conversation, is to recognize that taxes are, for many, many people, their absolute biggest expense. So you may have a salary that says it's $80,000, but that is not what you bring home. So we need to accurately assess what our take-home pay is. And I'm going to give this back to Brad in his former life as an accountant. I think he's going to stress the difference between, maybe what you're setting aside to pay for taxes in contrast with maybe what you owe.
Oh, Jonathan, you know me so well. You saw my eyes light up when you said take-home pay, right? Because, yeah, I mean, I think we're not going to go on a long, in-depth analysis or rant on taxation, certainly, but it's important to know that, sure, what you take home is a close enough proxy to your after-tax income, but it's really not, because a significant aspect of it is, all right, what kind of tax refund are you getting, right? So you could say, oh, my take-home amount is X. I get paid twice a month, so I multiply that amount by 24, and that's my after-tax income, right? But if you're getting a $20,000 tax refund, then I think you really need to add that $20,000 to what your take-home amount is, because I guess the really critical point here is there's withholding. So when you look at, and this might be maybe the very first time you've looked at your pay stub really in depth, just take 3 minutes. This is honestly not that hard. You're going to see a gross income amount. So that should tie to what you know your salary to be, right? So like Jonathan, you said you're making 80 grand. Let's say, again, you get paid 24, 26 times, whatever it is. We'll say twice a month. So 24 times, it's just going to be 80 grand divided by 24. All right. So that's what's going to be there for your gross income. But then there's taxes, right? So you're going to see payroll taxes on your pay stub. Okay. So that's going to come out to 7.65%. All right. Probably 99% of cases, there's some additional, I think on high incomes, there's a little extra, but for the vast majority of us listening in general terms, 7.65% of your income just goes to payroll taxes. So that's largely going to be Medicare and Social Security.
So right out the gate, your 80,000 is going to look a lot more like, let's see. So you said, what was the percentage again?
7.65. 92.35% of that left.
So around 74,000 is what you have left at this point.
Yep. And then you've got your withholding. Okay. Now, this is the amount of money that you set aside. That's the best way to think about it, is you're setting this money aside and sending it to the federal government and your state government to hold on account for you for your income tax liability. Okay. This is not, very critically, this is not your income tax liability. This is just the amount of money you're sending them to hold to cover for you. Okay. Now, theoretically, if you wanted to do something crazy, you could send all of your money to them, right? Like that doesn't mean that's your actual tax.
Not financial advice. Not even personal advice.
Please don't do that. Please don't do that. then you very obviously would get a humongous tax refund, right? So again, that's why I said you have to add your tax refund to this take home amount, because it's basically you set aside an amount and said, I think my income tax liability is going to be this amount. But then you file your return and you find out what that income tax amount actually is. And then the difference, if you've under withheld, if you didn't send them enough, you have to cut a check, right? Because you owe more. But most people over withhold. All right. So they basically said to the government, hey, just hold this money for me. And it's actually extra. Then you get the tax refund. So just really mechanically, Jonathan, I know we don't want to get bogged down in this, but I think that's a good starting point, right?
I do. I would say, to add some flavor onto that for individuals that are thinking, all right, what does that mean for me? Basically, if you're getting a $6,000 refund every single year and you look forward to that because it's a form of forced savings, maybe that might be an appropriate mindset. But long term, I think the way to recognize that is an extra $500 a month that you could have had to incorporate into your budget this entire time to do with as you wish. It's not an accident. The government hasn't made a mistake and they're just giving you more than you expect. You've just decided to give them all that money up front and maybe they'll give it back to you, assuming that things don't take longer, right? Like, it's just not a winning strategy. And so the mechanism for moving this up and down, and now this is really outside the scope, but I just wanted to point out there's something on your, it's called a W-4. Your HR department has access to it. You can probably access it through your employee portal. And on there, you can move up and down a number to tell the government to hold more or to hold less. And so the simple way to think about this is if you increase, I think it's a scale between like 1 and 10. It might go a little higher than that, but it's a scale between 1 and 10. If you move the number of exemptions up, then the government is going to take less, which would allow you to keep more. And conversely, if you're owing taxes each and every year, well, maybe you want to take the time to send this to them sooner so your tax bill will be cleaner, in which case you could move those exemptions down. And then even if you move it all the way to 0, which is obviously the lowest number, and you're still owing at the end of the year, you can actually go in there and say, I'd also like you to hold an extra certain amount of money on top of this each and every paycheck to get it closer. Outside the scope here, I think the larger point is for those of you that are just getting massive refunds each and every year. That's really the emphasis here. And you don't realize that it's not an accident. It's just that you're paying way more than you need to. You could probably go in, increase the number of exemptions on your W-4, and you can bring that money that is yours. It's yours each and every year. The forced savings plan is very suboptimal, in my opinion. You should just have that money in your monthly cash flow so you can use it as you need it. It gives us more accurate numbers to work with. We can be investing the money sooner. We can be paying off debt that's happening at a very high interest rate if that's the case. That's just the big take home here. Taxes, for many people, your biggest expense and underappreciated.
Yeah, that was really great flavor, Jonathan, for sure. And yeah, so I think most of us should just say, all right, what are my taxes? Within reason, plus or minus, it's going to be that 7.65% plus the amount you see on your tax return as your total liability for your federal and total liability for your state. So you just subtract that out and then you have an amount. All right, what's my after tax income? And then, of course, we'll talk about this in the mortgage because there's always ways you can look at this, right? Like you have property taxes. That clearly is taxed. If you felt like putting that in the tax bucket, you obviously can. But most people send off one mortgage payment. And in that mortgage payment is going to be principal and interest. But then there's an escrow amount, which is your taxes and your homeowner's insurance. You don't want to mess this up and double count things. So I personally, and again, this always comes down to what is best for you personally. I just kind of include it in my mortgage payment because for me, that's how I see it. That's how the expense comes out every month. So I just kind of consider that. But I think it's very reasonable to say, all right, I can pull it out of my mortgage payment and then just add that to my tax liability just so I have a clearer sense. But I don't think there's a right answer personally.
Well, that's a good point. So when we look at expenses and we talk about taxes, certainly most of us think about our income tax, but there is also, as you pointed out, you could think about property tax. You said it's folded in, but there is also many of us have things that maybe we forget about, like that HOA fee that pops up. You also have property taxes on your vehicles in many cases that pop up on a somewhat annoying basis. So maybe there's something else that we haven't thought of that would be applicable to you, but you do want to think through those expenses because those are obligations that you have and they're going to need to be paid. And you don't have access to the income that's obligated to those, to those tax bills. So we're going to work through those obligations right now. And so the next one, obviously you mentioned real estate. Let's talk about the mortgage or rent. I mean, if you think about where most of your money goes to, it's going to go to taxes. Sure. Let's include that. Your mortgage or rent. And then transportation would probably be the next one. And then food as the big three. Again, the point of this is not to get you to make any changes to anything. It's just to identify those. So in the context, really, let's talk about what we're actually trying to do here. We want to get a sense for what our life actually costs. We also want to have a realistic understanding of what we're actually bringing home. So the first exercise was just, what is your actual take-home pay, and is that accurate? If you make your salary is $80,000 a year, you're bringing home $74,000, but you're owing or you're getting a massive refund of tax bill, we might make some slight adjustments. But what am I actually making? Let's start there. Let's put that to the side and then somehow manipulate whatever that number is into a monthly number. I think that's going to be the most useful. So if you get paid monthly, it's very obvious. If you get paid biweekly, then take what you make on a biweekly basis, multiply that by 26, divide by 12. If you get paid bi-monthly, 1st and the 15th, just multiply by 2, right? Yeah, just multiply by 2, and that's done for you. And I'm sure there's someone that has something else, but weekly, I'm not sure. But we want to convert whatever we're getting to a monthly basis because most of our bills, our obligations come on a monthly basis. So hopefully now over here on your document that you're starting to create, you have my monthly income adjusted for whatever my tax obligation was at the end of the year.
Right. And it's important to not get bogged down in this. Like you said, Jonathan, you figure out what works based on, hey, what does my life normally look like? I think, for most of us, it's going to be monthly, but you might have some different type of income or whatever it may be. Like, you got to figure this out for yourself and do not get bogged down and let that kind of complexity just stop you from moving forward. The only thing that matters from this exercise is that you complete the exercise. It's not that you get it perfect.
We've probably spent like 5 times more time than we were planning on this. And it was only because we saw a really cool opportunity sidebar to talk about how you could adjust your W-4. It's really not like if you have a $6,000 refund and you don't want to factor that in, like just do your take home pay.
Get the refund.
If you just want to go simple, this is for you. You can always correct it over time or adjust it. So let getting this exercise done be more important than getting it down to 1% accuracy. You can have some error in here. Okay, so let's talk about expenses now. We'll go through these a little bit faster. And you have your own. They're going to be probably different than what's on our list. Please adjust these, but we just wanted to maybe spark some thought since we put some time into thinking about what they would likely be for the largest swath of people possible. Mortgage, utility bills, debt is an interesting one. So, it could be car loans, could be student loans for many people, could be medical bills. One that's kind of interesting and probably should have a little bit of nuance attached to it is credit card debt. Many people do have credit card debt. And so because we're going to talk about what your life actually costs, I think it's probably important to carve out a couple extra minutes here, Brad.
Yeah, agreed. So, right, if we're talking about again, I'm going to put my accountant's hat on and talk about the income statement side, right? That's what we're talking about here, the expenses, not the total amount you owe. That's more of the balance sheet side. Again, that's the what do you own, what do you owe? So let's say you have $30,000 of credit card debt. Okay, that entire $30,000 would be put onto your liability section. But again, we're going to talk about that later this episode. But for right now, you have to think about, okay, what is my monthly obligation from that? And I think it's also another just slight level of nuance here, Jonathan, is clearly somebody who is using their credit card. Like my family, we use our credit card, we pay it off on time and in full every single month. So we have no existing debt, but a lot of our expenses just get dumped onto that credit card. So it's not going to provide me much detail or nuance if I just say, okay, credit card bill, $2,000. That doesn't really help me for this exercise because ultimately I want to carve out, hey, what's going into that number every month, right? And obviously the number isn't exactly that every month, but just to get a sense of, hey, what are the subscriptions? What am I paying for? I signed up for the New York Times a year ago and now it's jumped up from $4 a month to $16. Am I still using the damn thing? Little things like that you wouldn't see if you just looked at your bank statement and said, oh, my credit card bill was $2,200 this month. Sure, that provides you a little bit of detail, but not all that much, right? So I think it's important to note that a lot of those things are going to have to be carved out, the month by month. But then, Jonathan, like you're saying, it's this intersection of, okay, if you're someone who has existing credit card debt, you're not supposed to go back and figure out what made up that debt. What are the components? Hopefully from this step forward, from when you're join the FI community, when you're trying to get your finances on track, you're hopefully not going to be in a position where you're adding to that debt. So kind of how I would see it conceptually in my head, and again, you have to figure out what works for you. I would then lump that amount and just figure this is past incurred debt. Okay. And that's what I owe. And then you have to figure out, what do I have to pay on that every single month? And Jonathan, there is some nuance here. There's no right answer, because you could look at it, I'm thinking just off the top of my head of like, okay, what's the minimum payment? Is that my expense a month? No, that's not great, because obviously then you're going to get crushed with interest. If you decide, hey, I'm going to pay this off, this 30,000 over 30 months, do I put $1,000 as my monthly expense? That's kind of arbitrary, because if you had a bad month, you could pay less. You could pay, there is nuance. And I think that's what I'm trying to get across.
Right. So in the spirit of the audit, without actually implementing action at this point, we just want to identify what was the choice you were making going into this, I think.
Yeah.
So, the big distinction there, we're talking about prior debt that we have, that we recognize as debt that we're going to pay off, not monthly. Like I buy all my groceries with my credit card. To me, that doesn't fall into credit card debt. I pay off my balance on time and in full, as you were pointing out, Brad. But if you're sitting on $15,000 of credit card debt, if you were currently making the choice to make the minimum payment, a very suboptimal decision, but that's not the point of this. That is what we're going to talk about as our amount. If you are already paying extra, maybe you're paying $500 a month on something, then just include that. Again, we're doing an audit. We're going to come up with some sort of gap at the end of this, and we'll figure out how we can best utilize our income, how we can handle or round up our debt, how we can organize and optimize. We'll get to that. The financial audit is the first exercise. I hope you guys actually take the time to go through this with us. So what we just identified, though, is we want to identify credit card debt that we're going to make a plan to pay off, a snapshot in time. But what we also would like to do is identify how much we spend on these additional categories, which probably were put on our credit card, right? Many cases, a lot of my spending goes on a credit card, but we need that information. We don't want to double dip, but we need that information. So just keep that in mind. Definitely break those up.
Hey, this is Andrew from the Choose FI team. I hope you're enjoying the show. We're going to get right back to it after these quick messages.
All right. So then now we're working through our list. We talked about debt. We talked about making sure that is on our expenses that we're paying on a monthly basis. We're going to continue with food. We're going to include transportation, in this case, if debt included your car payment, then transportation, all we're really talking about is, a gas, I guess, or, maintaining your car. You can organize these in any capacity, but just don't forget about it. You do pay gas. Maybe you have an easy pass. Maybe you pay tolls on a regular basis. Maybe you use Uber. Just don't forget about all this. And then
insurance, Jonathan, that could be a separate category, or you could dump it in transportation. It's however you want to see this categorized.
Yes, so you're right. I put it in a different category just because there are so many different types. We have life insurance for many people. We have car insurance, medical insurance for most people is probably going to be folded into your employer. So if that's the case, I probably wouldn't worry about that. You handled it with the exercise with your take-home pay is basically folded in. But maybe you have an umbrella policy. Maybe you have some other form of insurance. Maybe you have cell phone insurance. Have you done a cost-benefit analysis on that? Well, Jonathan, have you seen how many times I've dropped my phone? Okay, you did the cost-benefit analysis. What we folding these under, these are obligations. Now, could you optimize any or all of these? Absolutely. But you're obligated to them as currently constituted. You need them to run your life. When you move back down, I wasn't able to find the perfect line for this, but I think there's a line in the sand. You could call them comfort. You could call them just part of our life, choices that we've made. I don't lifestyle choices, regular payments that we have to make, but we all have them. And so I can rattle off the list, and Brad, we brainstormed a little bit going into this. So I think it's relatively comprehensive. Gym, cell phone, entertainment, dining out, subscriptions that you might have. So this is the Ted Lasso category. Gifts, charity. So gifts and charity could be the same. Clothing, education, grooming, home supplies, toiletries. This is what I kind of wanted to point out, because there's a lot of people that just are kind of overly harsh on themselves with the grocery category, not recognizing that grocery folds so many other categories into it. And all you end up seeing is just how much you spend at the local superstore.
Yeah, you're right. And I mean, life costs money, and I think a lot of us kind of underestimate when we think about, like we always talk about the $2 per person per meal. Like if you multiplied that and then went to your grocery bills, like you said, it's going to be significantly higher because there's lots of stuff to buy for the house. I mean, again, this is not about beating yourself up or congratulating yourself because how low your expenses are. It's just about what is the audit. So it's important to take note that all these categories, they do add up, right? Like gifts, Jonathan, things around the house, like maintenance on your house or your whatever it may be, like all of this stuff, we don't really think about it. So that's kind of the exercise that we're going through. And I think, like you said, you can list out all these things, but what's another way to do it is to really just go through your bank statement, right? Log into your online bank, just kind of eyeball the last 90 days. See if anything sticks out to you. Then go to your debit card purchases, your checks, your credit cards are the most obvious, right? You're going to want to just kind of scroll through some of your statements and just see like, oh, there's that thing that it might only be once a year and I forget about it, but it's, a couple $100. Like I'm thinking we have a stupid alarm system on our house. Like that's whatever, $30 a month, but I pay for it in one fell swoop and I probably would forget about it. So you don't want to miss things like that,
Pets, clothes, vacation, travel. All right, just use these as a springboard. Yours is going to look different. Gifts.
Not comprehensive.
Yeah, not comprehensive. But I tell you what, gifts is one of the, talking about like, I think this is actually an important thing. We just want to get you want to get an idea of what an average month looks like. I think going into Christmas, I'm the oldest of 5 kids and I've got nieces and nephews now and my family keeps getting bigger. And I tell you, right around November, we all start to strategize how we're going to do Christmas. Like, man, there's a lot of gifts that are being aggregated for this single event, Christmas plus birthdays. It just starts to, it's like, it's not scalable. And we're past that point, but we're always at like late November where we're like, well, should we get everybody in the family to agree to just do like a white elephant exchange type deal? And then it's just a lack of communication and we never quite pull it off satisfactorily. So we all just end up with some hodgepodge. But having said that, gifts end up being a big, big category, but they only land 1 or 2 months out of the year in many cases. So, there could be some sort of like offset expenses where you have these crazy amounts that are being spent. You just lump those together. And what you could do is just divide by 12 and then say, does that feel about right? You might be surprised, you might be shocked, but it might actually be accurate. And then you could just say, all right, so for things I missed, the catch-all category would be this extra amount of margin that around each month, this is what it costs. So I think that would be a pretty comprehensive way to tackle what our expenses actually are. And if you could do that, now you have your monthly take-home pay, and then you have an estimate of your monthly expenses. We are in a phenomenal place to start figuring out what path we are currently on.
Yeah, agreed. I mean, that gives you the detail that you probably have never had before. And again, the real goal of this exercise is to just be honest with yourself and be in a position where you can make decisions moving forward. And having that information in front of you, again, maybe for the first time in your life, or if you've been on the path to 5, like you might have done this years ago, but that checkup is really important because life changes. Things change all the time. You might have increased expenses somewhere, decreased expenses another place, got a new job, like a lot of these things, and you may not have updated, all right, what do I want to do with this? Where does this money go? So I think that's kind of the launch pad. And Jonathan, hopefully we're going to do a future episode on that, is what is the actual action? It's, you got to start here, but it doesn't end here.
Right. And so here's kind of the challenge to people. We're starting out the year. Let's do a challenge together. We'd like to extend an invitation to you to take a week to go through this episode and map it out to your own life, to do your own finances. So make this the one action you take this week. You have 1 week. Your homework assignment is to go through this exact exercise on paper. You're going to have, what is my monthly take-home pay adjusted? And then what are my monthly expenses averaged out, just averaged out. I don't need every single month exact detail. You just want to have that. And so what we'll know immediately on the other side of that is just a gross look at our savings rate, a gross savings rate, or a potential possible savings rate. There's a lot more to do with this, but obviously if your expenses are more than your income, that would explain why you're stressed out, right? Persistently stretched out. That is information. If you are breaking even, that will show you why you're not making the financial progress that you thought you were making. And if you have a significant gap, we can then address, well, what are we doing with that gap? Any of that information, all that information is useful. It provides us forward action. And we'll talk about, and we're not done with this episode, but we're going to move on from this place because we're going to build on this. When we come back next week, we're going to do what we call in the corporate world a SWOT analysis. Strengths, weaknesses, opportunities, threats, right?
Fancy, Jonathan.
Right.
Fancy.
So SWOT-FI, right? We're going to bring that back in and we're going to take a look at what this financial audit told us about our current financial picture and then what we might want to do with that. Now, that's for those of you that are just getting started. We also want to really circle back and address those of you that have been doing this for a significant amount of time. I got value from doing this exercise personally. I canceled Ted Lasso because I'm caught up and it's going to be another year and I'm not watching Foundations, right? Like it's going to be a long time. I have other subscriptions that I'm in the process of canceling that had just caught on and I forgot it. There's a few things, few little optimizations I was able to make because I was getting zero value from services rendered and I was just paying out for it, I was able to tighten up a few things and also have a better relationship with what my monthly cash flow was because of this exercise. So this is not for people that are just saying, ooh, day one. This is for people that have been on the path for a while as just a regular thing to do. Having said that, there's additional steps that we can do when we have been on this path for a period of time. And that is take a look, going to Brad's side, taking a look at the balance sheet. And Brad, this has been an annual practice for you for close to a decade now, maybe longer.
Yeah. Yeah. This is something I do not only annually, but I do it every quarter. And it's a really, really easy exercise, but I find it very valuable just to have a real idea of what is the state of my financial life. Again, what do I own and what do I owe? So what that actually comes down to is then what is my net worth? So I take all of my assets, I add them all together. I take all of my liabilities, all my debt, everything I owe, add that all together, and then just subtract the liabilities from the assets. And that gets me to, in my case, a positive number, and I have a positive net worth, right? And it's really very cool to track this journey to FI, this journey that we're all on together. And I think a lot of people don't realize, like we say, this is an intermediate time frame, right? Like the path to FI, it's not get rich quick. It never will be. That's just not possible. But over an 8, 10, 15-year period, you're going to be well down the path to FI. Many people will get to FI in that kind of time period. And it's really, really cool for me to see that on a quarterly basis, like you said, over a decade plus. And I can go back to my third quarter results in 2012 and see, oh, what did my financial life look like then? And it's kind of a cool thing. So just like everything in life, I don't want to get bogged down in detail. I don't want to overly complicate things. I don't want to spend a lot of time. So for me, this is like a really, really easy exercise. It's just look at every single account that I have. And Jonathan, a lot of these umbrella categories, 401ks, IRAs, Roths, HSAs, all of your bank accounts, right? Your taxable brokerages, if you have any places like Wealthfront or Fundrise or, any of these online accounts, just any account that you own. If you have crypto, right? Like any of this stuff, if you have an asset category, for me, the easiest way is to just kind of separate each of those accounts. And then, this is as low tech as can possibly be. I just list them down in an Excel sheet and I just put the balance on that day, right? So for me, it's the last day of every quarter. But if you wanted to do this once a year, it's fine too. Make it, you do it every January 1st. So as of 12/31 of the year that just ended, these are all my assets. These are the accounts that I own, right? And you put the balance. There's nothing else to it. You just literally need to log in. You see what your account balance is and you type it into an Excel sheet. Simple as that.
So I think what we've really set ourselves up for, just to mention in passing, is what do we know about ourselves? Like if we know our net worth and we know our expenses, we know our savings rate, like what does that tell us about our FI number? And so first, I want to just encourage those of you that are taking this challenge with us and want to continue to get this information, on this path. You really should be a part of Brad's weekly newsletter because we're going to be talking about this series, talking about this journey together. We'll be sharing wins and providing content to really tee you up for that next piece. It's the easiest way to get on that weekly newsletter. Comes from Brad every Tuesday is to right now just go to choosefy.com/subscribe and just join the newsletter. It can't be any simpler than that. And Brad will be following up with some targeted content around this exact theme, really setting you up to follow us on this journey. And this applies to you as well. Even if you're doing this, months from now, if you're listening to this episode, you're binging the episodes, you're coming back to it, still go ahead and do that because we're really going to make it easy for you to access this guided content no matter when you subscribe. So just a little call to action there. All right. I wanted to come back now to actually the FI number. So I think a lot of people, and Brad, one of my favorite rants of yours all time is ranting on how all of the retirement calculators are broken. Because I think so many people, and I'm going to give it back to you, I'm not stealing your thunder here. So many people take a look at their income and then go straight to the retirement calculator.
Yeah, I think every retirement calculator essentially that you see anywhere in existence online starts from a fundamentally flawed starting point because they presuppose that you need to replace the entirety of your current income, which is just stupid. Frankly, it's the dumbest thing I've ever seen. It's just not right. Just taking it at its most simplest standpoint, let's say you make $100,000. If you are spending every dollar of that, you have 0% savings rate. You will never get to financial independence ever in your entire life. And therefore, who the heck cares? The retirement calculator is ridiculous because the answer is never, right? So built into that, and I know, Jonathan, I know you want to jump in here, but
No,
built
I'm
into
happy,
that,
man. I wanted to let you get angry, and I see it. I see the, there's some
I
tamales.
don't
You're
get
spitting
angry
tamales,
about all that much stuff.
Yeah. I'm pretty sure that they do ask you what percentage of your income you're going to do. So just to give them just the tiniest bit, lest someone correct us, but your larger point is well stated.
Right. In fairness, I suspect they have updated over the years. I do not have a big enough ego to imagine that it's because of my rants, but at least the old ways that these used to start is, what is my income, right? And obviously built in that income is savings. So you don't need to cover that amount when you're in retirement. And also built into your current income, like we started, is a significant tax amount. And now presumably when you're at a point of retirement, your income is going to be dramatically less, if not zero. And therefore your tax burden is going to be dramatically less, if not zero, if you play your cards right, right? And that's another kind of fun aspect of the FI community. But anyway, the most important point here, so I'll end this, is what you actually need to cover is, what does your life cost? In a perfect world, when you are at a point of financial independence or retirement or whatever phrase you want to use to describe it, you need to cover, what does your life actually cost? What are your yearly expenses? When that is covered in either passive income or passive-ish income or whatever, pension or whatever it may be, real estate income, plus a certain percentage that you pull out of your liquid net worth, all of those assets that you own, when you have that amount, and Jonathan, you're going to talk about that in a minute here, then you've reached that point of financial independence. And that is, again, the starting fundamental point is not your current income. That's irrelevant. All that matters is, what does your life cost?
So I think that really sets this up. What does your life cost? If you know how much your monthly expenses are, it's very easy to turn that into annual expenses. Once you have your annual expenses, you can multiply that times 25, which gives us a rough calculation of something that the financial advising community would call the 4% rule. And that is basically, so let's do this out loud now. Let's say your life costs $40,000 a year. Then you multiply that times 25. The number that would come out of that would be $1 million. And the 4% rule provides for us what we generally start with as your financial independence number. If you had $1 million in investments accounts producing real return, you could expect that money to last for the rest of your life. You would not run out of money. That money would still be there. And in some cases, depending on market, you might even end up with more than you started with. That's possible. Not necessarily guaranteed. It's not built in the calculation, but it has happened over, many, many stretches of time. Now, this 4% rule works regardless of what your monthly expenses are. So if you have $80,000 a year of expenses, you multiply it times 25, then your FI number would be $2 million. You would need $2 million in investments to produce some sort of return to be able to fund an $80,000 a year lifestyle for the rest of your life. This is just how the 4% rule provides for us that information. And it pairs very nicely once you have that with, well, how much do I actually have in investment accounts?
Right. And that's the intersection of these two, the income statement, the income and expenses, and that balance sheet, the assets and liabilities. That's the intersection point for your FI number. You need one, you need to have that idea of your total expenses to figure out the other, which is, what is my ultimate goal here in terms of net worth? And now, Jonathan, it's really important, and we always say this, that 4% rule is at best a 4% rule of thumb, right? There's nothing sacrosanct about that exact amount. And once you get to that dollar, you're set for life and you can ride off into the sunset. There's always nuance to life. And, if you talk to someone like Karsten, Big Earn from Early Retirement Now, he would say something on the order of I think 3.25% safe withdrawal rate was the last amount that I heard that he said is nearly guaranteed. Nothing is guaranteed in life, but nearly guarantees you a safe withdrawal rate. So instead of multiplying by 25, let's say you want it to be super safe and multiply by 33 or 35, right? Like, you can work around depending on how conservative or aggressive you are, what your situation is, et cetera, et cetera. It's not our place. But what's really important is this gives you something to shoot for that is very, very realistic, right? So you come up with whatever that number is, however conservative or aggressive you want to be. 25 times is very, very reasonable. Gets you to that 4% rule. You want to be a little more conservative, do 33 times, whatever it may be. And at the very end of this, you're coming out with a number that is my current financial independence number.
Okay, so that really sets us up nicely to bring in what is my current net worth? So if you have a number that you've calculated, you can subtract your current invested assets, your current net worth from that, and then that's what you need to get to. The big point here, and we're going to go into more depth over the coming weeks and months, but the big point here is that it's not binary. It's not, 0 or in debt or FI. And I think this is the biggest misconception around this path. It's a continuum. And so this is why I was saying to people that are listening to this that are already on the newsletter, you're in good shape. This upcoming Tuesday, we are going to follow up with the checkpoints of FI. You're going to get this in your inbox, the checkpoints of FI. And we just want to encourage you, once you have this assessment done, to see how, to have fun with this and recognize you've made tangible progress and be able to put some words to that, to have a common language to say, I'm at Coast Fi, I'm at Barista Fi, I'm at Mortgage Fi, whatever you want. That's fun. It's non-serious, but at the same point, you should recognize that there are tangible wins that happen the entire way. I have FU money. You'll have this framework. You should be able to map it up. We're going to put some care and thought into that newsletter you get following this episode and just kind of enjoy that. And then we'll build on that content by looking at strengths, weaknesses, opportunities, and potential threats in the following week's episode. For those of you that are sharing the concept of financial independence with friends or family down the road, you have someone that you want to go through this exercise maybe many months later, because I think getting started is the place to start. We have set up, talk about being on the path. We've set up a Pathfinder for you. You can go to choosefi.com/Pathfinder. It's a curated email series to walk you through each step, absolutely each step of this journey to financial independence. We're aggressively building out. We're putting resources behind it. We think that it is the absolute best tool to take someone from never having contemplated this idea of financial independence to being well on their path, really in a series of months, having the confidence, having the common language, having an understanding of the principles, having a solid foundation to take that next step and change their financial trajectory. So please be an ambassador for this concept. And the best way to do that is to, one, if you're not currently, you haven't gone through it yet yourself, check it out, choosefi.com/Pathfinder. And two, do what you've been doing this entire time. Share it with friends and family. Have them go to choosefi.com/Pathfinder and get started on their own path to financial independence. What an incredible gift. In a year of uncertainty, let's take whatever control we can back and use that to build a better tomorrow. All right, my friends, the fire is spreading. We'll see you next time as we continue to go down the road less traveled.